Hello, fellow Rebel Capitalists. Hope you're well. Check it out. The first ever live stream whiteboard video Q&A. This is either going to be the best idea or the worst idea in YouTube history. But you guys will be along for the ride in real time. So what we're going to do is we're going to go over the Treasury market. You guys know what's going on. Yields are exploding higher. Something is obviously broken. In addition to foreigners likely selling treasuries, and what's completely bizarre is that the dollar is tanking as well. The dollar closed today under 100 on the DXY. These things should not happen, especially when the stock market is not only crashing, but is so volatile, up and down and up and down and up and down. And by the way, usually you see this type of volatility in a bear market. So even if the S&P 500 is only down or up, 5% on the week, just wait, the VIX is still in the 30s and the 40s. And that means most likely the bear market or the bottom is not yet in. But again, no certainties, only probabilities. So what I want to start off with are some charts of three main, let's just say three main assets. So we've got equities, we've got bonds, which I'm just using the TLT as a proxy at long end of the curve, and we've got the dollar. And for that, we're just using the DXY. So we're going to bring up these charts. We're going to compare what's happening today with what happened during the cerveza sickness and what happened during the GFC. We're going to see if this is completely unprecedented or if this is par for the course when things start to break. And then, believe it or not, after we get onto the charts, we're going to go to the whiteboard and live, I'm going to go over what happens when foreigners sell these treasuries. And I'm going to assume this is what's happening in addition to the liquidity event that we're probably having as a result of the basis trade blowing up. But we're going to try to go over everything and connect some dots. And then when I get done with the whiteboard video, we're going to do a Q&A, a whiteboard Q&A on Rumble. So this is going to be awesome, guys. Make sure you write your questions down as we go so I can answer them on the whiteboard when we get to that portion of the video. So let's start off, Josh. Let's do a screen share, and I want to go over to my email. The first chart we're going to start with, can you see this, Josh?
Yeah.
Okay, perfect. So this is the S&P 500 today. And I tried to draw this black line here with my mouse. You can see it's not that great, but it serves the purpose. It's just to highlight this portion of the chart. These all are daily charts too, by the way, guys, just FYI. So where I highlighted it was just when we started April. So call it Liberation Day, or some people might call it Retardation Day, whichever you prefer. And we see the market just absolutely fall out of bed. But then we had the news on Monday that they might do a 90-day freeze. The market rips higher. Market cap gains $2 trillion. And then with a span of 20 or 30 minutes, plummets. They get the rug pull all the way back down. And then Trump comes out and says, oh, well, that's fake news. But then a couple days later, the day after, he says, oh, well, actually, we're going to go ahead and go through with the 90-day freeze, and we're going to bring all the tariffs down to a 10% flat rate with the exception of China. You guys know what happens. It's the largest green candlestick I have ever seen in my life. It goes, if you can see my arrow, it goes from all the way down here, almost at the bottom of my circle, and goes almost all the way to the top in one day. In fact, that's, if you look at the total length of the chart, like the stem or whatever it's called, I mean, it went from, if I'm reading this right, below 485, and I'm just using the SPY for a proxy for the S&P 500, and it goes almost up to 550, and that happens in the span of what, 10 minutes? something like that. And then yesterday, of course, it crashes all the way back down. And then today, just more volatility. It was down at one point, I think 600, and then it closes the day up 600. Just complete insanity. So now we know what's going on in the stock market. And this is nothing out of the ordinary when you get this type of uncertainty, whether it's the cerveza sickness, whether it's the GFC, dot-com bust, etc. So now let's go over a similar time frame, or hopefully the same time frame, and we're going to go over the TLT using that as a proxy for the long end of the curve, maybe 10-year, and then we're going to go over the DXY, because this is where it gets completely like bizarro land. So hopefully I can find this easily. That is TLT GFC, DXY today. Okay, we'll start there, and then we'll go over to the TLT. See if I can blow this chart up. There we go. So again, this is starting on Liberation Day, right around August 1st, and then we're going to today's date. And as soon as the stock market starts to crash, you see the dollar actually doing the exact same thing, which might not be unprecedented yet, but it's weird because you would assume this is risk off, and therefore the global economy going into the dollar. And then when we have these reversals and back and forth, the dollar actually goes back up to 103.5, and then it just completely pulls a Wile E. Coyote all the way down to, at a point today, it was almost at a 98 handle. I mean, it's almost below 99. And then it closes the day, where I took the snapshot, is a little above 100, but it actually closed the day, I think 99.9 or something like that. It closed the day under 100, which I think is really interesting because we're right on this support level right here that you guys can see by this, by my arrow, if you can see that black arrow shaking back and forth. So if I'm just a technical guy, I'm thinking, okay, this could be a bounce right here. We're going to have to wait and see what happens on Monday. But the bottom line here is, during this massive volatility in the stock market, up, down, up, down, up, down, the DXY, the dollar, is actually crashing in total, going from call it 104, to where it ends today, under 100, 99.9 roughly. So this is the first thing that is weird, to say the least. But what's completely off the charts, no pun intended, is when you look at this in relationship to not only what the stock market is doing, but what the bond market is doing, treasuries. So let's move over to the TLT. We want TLT today. And I'm, of course, not organized enough to have these in order. Aha! TLT today. There it is. So same thing, same time frame, and we have the TLT go up. So this means interest rates are going down, right? And it starts off exactly what you'd expect when the market just falls out of bed. And we had that down day on Friday of, let's say, 2,200 points on the Dow, roughly. So you would expect risk off, risk off, risk off, growth, inflation expectations plummeting. And we have the Treasury yield long end of the curve going down. Exactly what you'd expect. I think 10-year got below 3.9. But then what you would not expect, at least what I didn't expect, is this massive reversal to a point on Monday where yields went up on the 10-year by like 35 basis points within a span of a few hours. And now, I mean, we just go from 94 on the TLT all the way down. Today we're trading 86, roughly 86.49 when I took this snapshot, but it got all the way down 85. Again, interesting there, kind of on a support level, it bounced. So this is the total opposite of what you would expect. And I think this surprises me more than the dollar. But to be clear, the price action in the dollar surprises me as well, based on all the other factors, uncertainties. You guys have been following the news, the tariffs, and what we talked about, the volatility at S&P, the VIX being at 40, spiking up to 60. You know, they call the VIX the fear index for a reason. And if the VIX is at 60, you only see that at times like during the surveys of sickness and the GFC. That means fear is at an all-time high. If fear is at an all-time high, what have we seen in the past? You're buying treasuries. You're buying treasuries, safest and most liquid asset. Even if you think, oh, well, treasuries are stupid because they're paying a 4% yield and inflation is going to be 6, or that doesn't, in the short run, that doesn't matter. People are going to be a flight to safety and liquidity. But now what we could see, or what could be happening, not only a liquidity event, but all of these foreigners selling their treasuries. And this is what I got wrong yesterday, because when we were talking about the dollar crash yesterday, remember I thought, it's kind of a knee-jerk reaction because of what the Eurozone was doing. They put a 90-day freeze on their tariffs as well. So, but I think we can safely say I was completely wrong on that one. And I was reading some people that I've got a lot of respect for this morning, and they were making the connection of FX reserve managers selling their treasuries and not taking the dollars, but then taking the dollars and actually buying, as an example, German bunds. And this would explain why treasuries, the yields are going up, price going down, and why the dollar is going down at the exact same time. So I think there's a component there for sure. But that's what we're going to get into, and I'm going to explain it more thoroughly on the whiteboard so we can determine what will likely happen next, not just in yields, but in the dollar. Okay, so now before we get to the whiteboard, let's go over the surveys of sickness to see if this is what we usually get in, when we have these crises events, or is this something that's unique? So let's go to the, dang it. Let's go to S&P 500 surveys of sickness, DXY surveys. Here we go. Great. So same group of charts, guys, but just much different time frame. So this is right at the beginning of March, and then we go to April, basically. That's the point in time that I really wanted to focus on. So as you guys remember well, the market just completely tanks, falls out of bed, and the Fed comes out, emergency meeting, they drop rates down to 0, they announce up to $1 trillion a day in repo, and QE infinity. Now let's go over to the dollar and what it's doing during the exact same time. So I would expect dollar to be going up right here. Did I miss it there? We want DXY. There we go. So what's interesting is you can see we start off right at the beginning of March, and what did the dollar do? It tanked. It tanked. It goes from roughly 98.5 all the way down to, call it, 94.5. So in percentage terms, probably a bigger move than what we've just seen. And then what happens? The dollar just rips higher to where we get up to 103, and then kind of chop around a bit. And then after that, what does the dollar do? Goes up to 110, 112. You guys remember that. So now let's see what Treasury yields did. Here we go. So same time frame here, guys. March, April 2020. And we've got the TLT. So remember, when this goes straight up, that means the yields at the long end of the curve are going down. So right here at the beginning of March, yields plummet because everyone thinks the world is coming to an end. They're going into safety liquidity But then what happens? Yields skyrocket in the middle of March. They skyrocket where the TLT, because remember, the TLT is going down, yields are going up. So TLT up here, come on. TLT, I can't see it because this is shaded in, but it's roughly, let's call it 180. And it goes all the way down to under 140 within the span of a couple weeks. So think about, I mean, I don't know what the 10-year was doing around. I mean, that means the 10-year had to go up by, I mean, at least 70 or 80 basis points. At least. Again, probably an even bigger move. Now, I don't think that the total was probably a bigger move. I don't think we saw as big of a move as rapidly intraday. I don't think we saw that during the survey signal. So remember on Monday how yields on the 10-year went up by like 35 basis points in the span of an hour or 2 hours. I don't think we saw that during the cerveza sickness, although we did see yields over the span of, let's say, 2 or 3 weeks go up maybe as much as they have gone up over, from Liberation Day, retardation day, whatever, to where we are today, April 11th. But so far, what you can see here is it isn't necessarily unprecedented. And oh, by the way, what happened when yields skyrocketed during the cerveza sickness? That was the basis trade blowing up. That was the basis trade blowing up. So now let's go over to, I guess we saw the dollar. And now let's go to GFC. So the main takeaway there, guys, is what we are, if we just compare it to the cerveza sickness, what we're seeing right now in terms of the S&P 500, dollar, and treasuries, believe it or not, it's not unprecedented. Not unprecedented. And unfortunately, it's what you see when the stuff is really hitting the fan. So GFC, this is S&P 500. Now this goes from September of 08 to November as far as our time frame here. And as you guys, a lot of you remember, stock market goes straight down. And this is S&P 500. So now let's go over to the dollar during this time. And here we go. Isn't this interesting? So at the beginning, dollar, we have a period where the dollar does tank. The dollar goes, and again, this is when the world was coming to an end. Dollar goes from 80 down to 76. So definitely a bigger move in percentage terms. Definitely a bigger move in percentage terms back then versus what we saw today. And again, these are all daily candlesticks. And then what do we see happen here? The dollar just rips higher. Very similar to what we saw during the cerveza sickness. So now let's go to TLT GFC. Here we go. So same time frame. And we see yields plummet. We see yields skyrocket. We see yields plummet. We see yields skyrocket. We see yields plummet. It's making me dizzy just looking at this chart. Holy cow. And this isn't a span of 6 months, guys. This is a span of just a couple months here. Or this isn't a span of a couple years, I meant to say. This is just a span of a couple months. But look at this. Here's what I want you to notice. What actually happens at the end of my little circle. So the TLT rips rips from 94, call it, straight up to 122. What happened right there? QE. It was QE. Now let's go back to the cerveza sickness chart, TLT. What happened right here when yields plummet? TLT rips higher. It's QE. More specifically, it was when the Fed came in and bailed out the basis trade. So I think one of the questions, so first question, is what we're seeing today unprecedented? Answer, no. Unfortunately, it is par for the course, but only in times of complete chaos and only in times when stuff is properly hitting the fan. So good news, bad news, right? Good news is it's not unprecedented. Bad news is it is unprecedented outside of times when you have extreme bear markets, financial crises, stuff hitting the fan. But what reverses what has reversed the bizarre moves in the past was when the Fed steps in. Now, we can argue whether it's mechanical. I don't think it is. But even if it's psychological, the impact is essentially the exact same thing. So I think the next question we have to ask about today, and here's TLT today, or same thing with the dollar, is when does the Fed step in? Do they? Just based on history, I would guess that you're going to see this massive volatility with the interest rates and the dollar until the Fed steps in. I'm not talking about the Fed stepping in and dropping rates. Maybe that'll do it, but in the past, it's required something breaking that is obvious to the central planners at the Fed and them actually stepping in and doing a bailout or QE, whatever you want to call it. So my takeaway from looking at these charts is to sit back, wait, and try to figure out when the Fed is going to react. And remember, yesterday, CPI came out low, really low. In fact, month over month, it was negative. And today, we had the PPI come in at negative 0.4. Yesterday, CPI negative 0.1 month over month. So today, PPI negative 0.4 month over month. So my point there is the Fed has plenty of cover to come out and not only drop rates, but to start QE again. And I don't think they're going to be pinned against the wall saying, why are you doing this? Because you're going to, you're stoking inflation, or you're increasing the probability that we go to the 1970s or stagflation or whatever it is. I don't think anyone, I mean, there might be a few people, but very few people are going to accuse them of stoking the inflationary fire when you've got the CPI negative month over month and at 2.4, and you have the PPIs coming in negative 0.4 month over month, especially if we get to next month CPI coming out and it shows that we're a lot closer to 2%, their target, and possibly even under 2%. Okay, so Josh, yeah, thank you very much. I was going to have you do that. So now what I'm going to do, guys, I'm going to set down my computer and I'm going to do my best to go over this whiteboard video live. And like I said, what I'd love for you guys to do is just jot down any questions you have as I'm going through this whiteboard. And then we're going to go over to Rumble, and I'm going to do my very best to answer those questions for you, actually using the whiteboard. So if I need to, I can erase some of this stuff and I can draw different pictures, different stick figures, different balance sheets, and we can just go through this one question at a time and see how this works. So I'm going to put this here on my chair. I'm going to plug in my laptop. Okay, and here we go. Now, we're not going to do this in 3 simple, fast steps. I'm not that fancy yet because this is kind of the beta test of the live stream whiteboard video. Now, Josh, is everything good with the audio? You can hear me? You
Everything's going good.
Okay, so we start with 2 characters here. We've got foreigner Frank right there, and then we have foreigner Fred. Now, you can see foreigner Fred is upset. He's freaked out, not real happy. Where foreigner Frank, he's like, yeah, I'm good. Why is this? Well, let's look at their balance sheets. We've got assets on the left, liabilities on the right. On Frank's balance sheet, you'll notice he has a treasury. I've got it in green this time just to represent that's a treasury denominated in US dollars. Okay, that's why we got it as green. But you'll notice one of the reasons he's really happy is because he doesn't have any dollar liabilities. This is key. This is absolutely crucial. Remember at the beginning of this video when I was talking about some of the really smart people that I really respect, listening to what they're writing this morning, they're talking about FX reserve managers. Emphasis on reserve managers were selling their treasuries, taking dollars and buying German bunds. So we're going to kind of use that example right here. But the key there is these are entities out in the global economy, the Eurodollar system, that don't have dollar-denominated debt. They don't have dollar liabilities. And as we go through this, you'll see that's absolutely crucial. Now, one more thing I want you guys to kind of make note of before we move forward, and that's almost every single dollar outside of the United States was lent into existence. So if we have $1 right here, let's say coming out of the FX market, that dollar was created by debt, by a bank lending it into existence. Therefore, if this dollar still exists, that means there's $1 of debt on somebody's balance sheet on the liability side. That's crucial to understanding how this process works. Okay, so now that we're on the same page here, let's go back to foreigner Frank. So foreigner Frank looks at what Trump is doing and he says, yeah, I don't want any part of this. I don't know if my treasuries are going to be sanctioned. I mean, look at what the United States did to Russia. The risk is just too high. So, and most of my expenses are denominated in euros anyway. So I would much prefer, just for the time being, to be in assets denominated in euros. More certainty. Okay, so what he does is he takes that treasury and he sells it into the bond market. Okay, excuse me. He takes that treasury, sells it into the bond market, and then he receives dollars. I'm getting my arrows mixed up here in real time. Here we are, right? It's this arrow right here. So he's taking that treasury, he's selling it into the bond market, and he is receiving dollars. Okay? But he doesn't want those dollars. Remember, he doesn't want any dollar assets right now. So what he does is he takes those dollars and then he sells them into the FX market for euros. And then once he's got those euros, then he goes back into the bond market, takes those euros to buy German bunds. That's why we've got the B here. And I've got the blue square representing bonds or government bonds that are denominated in euros, German bunds. That's basically a German version of a treasury. So he's taking those euros that he got from the FX market by selling the dollars and buying bunds. So now if we look at his balance sheet, instead of having this treasury, we've just got a German bund. Okay, well, what has happened in this process? Well, the United States dollar definitely has gone down, all else being equal, right? Because he's taking those dollars and he's selling them and buying euros. So dollar euro, or the dollar against the euro, it's going to plummet right here. Well, what's happening to treasury interest rates? Well, they're going to be going down, all else being equal. They're going to be going up, right? Prices down. Because he's taking those treasuries and he's selling them, more selling than buying, Prices down, yields up. Okay, but now what I want you to notice is there is a time mismatch. So we're going to get into this in just a minute, but just kind of write that down or make a mental note of this, along with the fact that every single dollar out here that we're talking about has been lent into existence. Okay, great. So now let's go over to foreigner Fred, who's in a much, much different position. Why? Because foreigner Fred has dollar liabilities. He borrowed the money to begin with, and in this process of him borrowing from the bank, that's how these dollars were created. Okay? So he owes those dollars. The problem for Fred is he has to earn dollars or he has to borrow dollars. He has to roll the debt over because on the asset side of his balance sheet, he just has yen. That's his cash position. Okay? So let's kind of think through what his options are. Well, he has to make this monthly payment, let's just say. Or let's just say for a moment that this loan matures in 30 days. Because we have to acknowledge that most of the debt in the Eurodollar system that created this 75 trillion that's circulating and whatnot of United States dollars, it's very short term. It's not like a 30-year Treasury. Most of it is under 3 months. So it matures in 3 months. So if you think it's bad, the United States has to roll over $10 trillion this year. Think about the fact that the Eurodollar system has to roll over, call it $50 trillion every 3 months. Try that one on for size. So in order to make this payment in 30 days, Fred only has a couple options. Number one, he has to earn the money. Let's see, he owns a business, multinational corporation. He not only has to earn the money, he's got to earn dollars. Because if he's just earning yen, then what is he going to have to do? He can't make his payment for this loan because the loan's denominated in dollars and yen, so he'd have to sell the yen to get the dollars. More on that in just a moment. Or what he could do is he would just go ahead and roll over this debt. But let's get back to the mismatch, right? Because he needs the dollars in, let's say, 30 days. But foreigner Frank is dumping the dollars right now. So what can happen is the dollar right now, because of this short mismatch, can plummet, but pretty soon someone's going to need to get those dollars in order to pay this dollar-denominated debt. And I don't want to let out the punchline, but this could be why we see this happen so often when we get into these crisis moments, right? And by the way, it's not like foreigner Frank is selling these treasuries because he wants to. Maybe, but he might be selling them because he has to. That would take us back to the basis trade blowing up, okay? But getting back to foreigner Fred, so his first option is to earn the money. Well, his customer, let's say, is foreigner Frank. So Fred is going to send this stuff to foreigner Frank, and usually foreigner Frank would give him dollars. So then he could go ahead and make that loan payment. But unfortunately, foreigner Frank doesn't have those dollars anymore. Whether he was forced to liquidate, or maybe he just didn't want the risk, the uncertainty, whatever it is, he doesn't have those dollars anymore. So foreigner Fred is put into a difficult position where his dollar cash flow, whoa, I like that catch, is going down. No one ever has accused me of a lack of ability to multitask. That's for sure. All right. But he's got another option, fortunately. He can go ahead and roll over that debt. So here's the bank right down here. And he can go to the bank and say, look, I owe you this money in 30 days. It's time, it's coming up, it's maturing. Why don't we just do this? Why don't you go ahead and just lend me the exact same amount, and I'll use that to pay off the existing debt. You guys know how that works. We're just rolling the debt over. Now, this would be a very viable option. So first and foremost, I want to highlight the fact that going through this thought experiment, getting the money from foreigner franc for the stuff is no longer an option. We take that straight off the table. All right, so this is gone. Bye-bye. So now we're left with this option. The problem here is what's happening to global liquidity right now. It's drying up, it's vanishing. So, I mean, you got to put yourself in the position of a bank. If you're a bank right now, are you super eager to go out there and lend into the global economy? Absolutely not. You're like, hell no. There's no way I'm lending out into the economy in this environment. And therefore, you would be less likely to go ahead and be willing to roll over that debt. You're like, no, I'm shoring up my balance sheet. I'm shrinking it. I'm not increasing it or keeping it the same size because I see the economic storm clouds. I see all the uncertainty, right? So the bank says, no, Fred, we're not rolling over the loan. You got to pay up, buddy. You got to pay up. So this no longer becomes an option. Bye-bye. So then what would Fred have to do? He would have to take these yen and sell them into the FX market. I should have had this written up there, but that's fine. And he's going to have to sell these yen on his balance sheet for what? For dollars. So what is this going to do, all else being equal, to the dollar versus the yen? Dollar up. Dollar down here, dollar up here. And the main reason is because you just had a mismatch in timing. Now, if this loan was like a 30-year fixed rate mortgage, then you'd have 30 years in there, and then the dollar could really tank. Really tank. But because this debt is so short term, at some point in the very near future, someone is going to need those dollars that foreigner franc is selling into the FX market to get the euros, right here, to buy the German bunds. Now, Fred has another option. Let's say he gets those dollars and he's like, you know what, forget this. I'm not dealing with the United States. I'm in the same boat as my good buddy foreigner franc. I don't want to deal with this anymore. So I'm going to go ahead and take these dollars and I'm just going to pay off the loan and I'm not going to roll it over. So he takes these dollars, right, sends them down to the bank. We got this as our next option as pay. So let's say he pays this loan off because he doesn't want anything to do with the uncertainty, and not only that, all of his customers are no longer willing to pay in dollars because everyone's dumping dollars, right? So what is he going to do? He's going to head and take that dollar. He's going to pay off his loan. So the loan is no longer there. But remember, the loan is what created the dollars to begin with. So if the loan is no longer there, what happens to the dollars? Poof. They're gone. No more dollars. This is why if foreigners are dumping dollars, let's say, demand for dollars goes down, especially if liquidity is super, super tight, which it is right now, and velocity slows down with cash flows, even if Frank was willing to pay in dollars, he might not be able to pay in dollars. Right? So you have cash flows going down, velocity going down, you got liquidity seizing up. And that's why if you have demand for dollars going down, usually the supply of dollars goes down just as fast, if not faster. You see, because in order for the supply of dollars to not go down, you would need more banks lending or creating loans than are being paid off. And if the demand for dollars goes down, do you think dollar lending is going to go up or down? Obviously down. So then you have those loans being paid off. So on net, what's happening as the supply of dollars outside of the United States is shrinking. And that makes it even worse for the other Freds out there that still have the dollar liabilities on their balance sheet, because it makes it even harder and harder and harder for them to pay. And then it gets to the point where the only way they can pay is by taking the other cash, the yen, the euros, the pesos, the Aussie dollars, the Canadian dollars. It gets to the point where that's their only option. And they have to dump that, which makes the dollar go up even higher, which makes it even more difficult for them to service that existing debt. And let's remember, guys, that every single, and Mike Maloney, my very, very good friend, Mike Maloney teaches us this in his series, The Hidden Secrets of Money. I think that's what it's called, isn't it? Hopefully you guys can, I'm almost positive. Sorry, Mike. I'm almost positive that's what it is. Hidden Secrets. Josh, look that up for me, because I want to give Mike a plug. That's such an awesome series. But I haven't watched it in so long, I forgot the exact title. But what Mike teaches us there is that when this bank lends the money to Fred to begin with to create the dollars, right? You're not just creating a loan, let's just say with, well, I'll just do it like this. You're not just creating the principal, you're also creating future payments for interest. But see, you're only getting paid, there's only enough currency units based on the principal. So if this loan, let's say, is for $10, okay, there's $10 that's created, but let's say the interest payments in total are $2, but there's only $10 that exists. So what you have to have in order to service this debt is velocity, the exact opposite of what we see today, especially when there's a liquidity squeeze, uncertainty, and potential for a financial crisis. How'd I do? All right, guys, now let's shoot over to Rumble. Hopefully you've got your questions written down, and I'm going to go do my best to answer a few questions, as many as I can, right here using this whiteboard, going through the exact same technique. And you guys let me know in the chat, you guys let me know in the comments if doing a live stream whiteboard video like this helps you guys understand the concepts better than maybe just me sitting talking head in front of a desk, or maybe even better than me doing a whiteboard with all the editing. And I think that, when I'm doing the editing, obviously you can't ask me questions, but now you can. And I think hopefully that's going to make this even better. So guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. And I will see you just in a moment over on Rumble.